Hey everyone, why did the stock market take a big dump on Thursday? I think it was because of the initial jobless claims, which came in much higher than they predicted, and the Magnificent Seven earnings, which are coming in. They are good, but are they good enough to stop a recession? The tentative answer appears to be no. I think what preset the stock market to go down is the initial jobless claims. It previously came in at 235,000 jobless claims. They were forecasting it to go up a little bit to 236,000 jobless claims, but they were not prepared for the actual number, which was 249,000 initial jobless claims. It makes people wonder if the unemployment rate is going to go up. It previously was 4.1%. And they're forecasting that it's going to stay steady at 4.1%. But with that increase in initial jobless claims, the fear is that it'll go up to 4.2%. The reason that's a big deal is because it will trigger the SAHM rule, the SAHM rule, which is a rule defining that unemployment and joblessness is going up much too fast, too soon, too quickly, which could indicate the onset of a coming recession. Stocks sold off a day after a furious rally as volatility returns. Equities gave back most of Tuesday's gains as tech falters. Risks include economic weakness, the Fed being too late with cuts. I think in September, there's not going to be a debate about whether they're cutting. As we get closer to that date, I think there'll be a debate about whether they should cut with a 0.5 interest rate cut, a half a point. Investors hoping for a quiet summer are being sorely disappointed as turbulence pummels the stock market, spurring outside swings in U.S. equity indexes with the dog days of August now upon us. A spike in realized volatility and a massive rush to a safety of U.S. government bonds turned a busy week into a frantic one for traders trying to wrap their arms around the Federal Reserve's plans for interest rate cuts after it signaled a rate cut could be coming soon. The yield on 10-year treasuries fell below 4% to its lowest level since February 1st as markets anticipate a sharp reduction in borrowing costs before long. It was down to 3.97%. You know, this should be kind of good news, but what it signals is the bond market thinks we're going into a recession for sure, is the way it looks to me. The VIX, which is a measure of volatility on the stock market, which usually indicates a down market, has been over 15. And when it's over 15, you usually have a pullback, and it's around 18 right now. So if it gets over 20, in my mind, that's time to start thinking about shorting, possibly. But there's a measure called the NDX, which is a measure of volatility of technology generally, and that's even more elevated. Right now, as you can see from that chart, it's up around 24. So this is not a good thing. This indicates that technology is probably on its way down. And the AI, artificial intelligence earnings have been good, but not good enough so far. Amazon earnings mostly disappointed as they continue to want to spend money on artificial intelligence, which is a big part of Amazon's DNA, to spend for the future, and they're anticipating artificial intelligence will help them a lot. Amazon reported weaker than expected revenue for the second quarter on Thursday and issued a disappointing forecast for the current period. The shares slid as much as 6% in extended trading. On earnings, it did $1.26 per share versus $1.03 per share expected by LSEG. So their earnings were good, but it disappointed on revenue as $147.98 billion was lower than the $148.56 billion expected. Wall Street also looked at the web services numbers, which came in at $26.3 billion versus $26 billion in revenue, according to Street Account, which is good. It beat expectations on their web services. But their advertising did not meet expectations, as it came in at $12.8 billion versus $13 billion in revenue. There were mixed signs. Basically, some things they beat on, some things they were a little short on, but that isn't allowed. If you're going to turn back a recession, you've got to be reporting just blockbuster numbers, which did not happen. Looking at Amazon's one-month chart, AMZN, it finished the day on Thursday at 184. After it released its earnings, it went down another 14 points to 169. So when you're looking at this chart, you're looking at the end of the day. If they put the extended market on there, it would be down to 169. So before the earnings, it had lost 4.75%, almost 5% for the month. But you add another 7% on there, and you get a 12% loss in the last month, if that holds up, that 14-point loss in the aftermarket. Its relative strength before earnings were announced was 45, which is right in the middle, but it will be less than that once those decrease in earnings flow through the market the next day. Apple did somewhat better. Apple predicts boost from AI features after an uneven third quarter. Customers will have a compelling reason to upgrade, CEO says. And that's true because I'm planning to upgrade around November when I figure they've gotten most of their artificial intelligence features into the phone. Sluggish China revenue marred strong performance last quarter. Apple said that total sales in the September quarter will grow at a similar level as the just-ended period, implying an increase of about 5%. Wall Street has projected a 4% clip. Services will be a highlight in the period, advancing in the double digits, executives said. Earnings amounted to $1.40 a share in the third quarter, exceeding the $1.35 analysts had estimated. The period ending in June is typically one of Apple's slowest, coming at a time when many consumers are waiting for the next iPhone to arrive in the fall. Sales of Apple's flagship product, the iPhone, came in at $39.3 billion. Though the number was down slightly from a year earlier, it edged past Wall Street expectations. 3 months ago, the company declined to forecast iPhone revenue for the June period, a signal it was still unsure about the shaky smartphone market. And looking at the chart on Apple, AAPL, you can see that it ended the day at $218.36, and it went up about $1.45 to $219.80. So there was a slightly positive reaction to its earnings, which is not enough to quell in recession fears. But hey, we'll take anything at this point. Its relative strength was 49, which is, of course, right in the middle. And it's probably just going to go sideways, is my feeling with this stock. I think they have the fall quarter coming up, and that's usually positive for Apple as they renew their phones. And I think people are probably a lot like me, that they're thinking, it might be time to change my phone. So the market, frankly, has been doing what I've been predicting, that the Magnificent Seven's earnings would be good, but not good enough to fight the recession. We have one last hope, and that rest entirely on NVIDIA, which reports earnings on August 21st. they could blow it out of the water simply because all these other companies are spending their money on NVIDIA's chips. So somebody might be benefiting greatly, and if it's anybody, it's NVIDIA. That's the way I roll. Thanks for watching.